In 1992, one trader made $1 billion in a single day. He did it by betting against one of the strongest currencies in the world, the British pound. That man was George Soros, and his approach wasn't luck. It was the result of a mindset built on uncertainty, bold risk-taking, and an understanding of how markets really work. Today, let's break down the lessons and strategies of George Soros, the opportunities he seized, the challenges he faced, and what we can learn from the man who broke the Bank of England. Principle 1. Embrace uncertainty. Most traders seek certainty. They want a clear signal before acting. Soros did the opposite. He believed markets are inherently uncertain, and that traders must accept being wrong often. His philosophy was, it's not whether you're right or wrong that matters, but how much money you make when you're right and how much you lose when you're wrong. This meant he kept losses small and pressed hard when opportunities appeared. Lesson: don't fear being wrong. Manage your risk so mistakes are survivable and wins can be amplified. Principle 2. Reflexivity. Soros introduced the idea of reflexivity, the belief that markets don't just reflect reality, they shape reality. For example, when investors believe housing prices will rise, they buy more, which pushes prices higher, confirming their belief. This cycle can create bubbles, and when confidence collapses, crashes. Soros used this insight to anticipate turning points. Instead of asking, what is the market reflecting? He asked, how is the market influencing itself? Lesson: market psychology creates feedback loops. Recognize when optimism or fear is driving unsustainable moves. Case study Black Wednesday, 1992. Soros's most famous move came on September 16th, 1992. Black Wednesday. The UK was part of the European exchange rate mechanism, which kept the pound tied to other European currencies. But Soros recognized the pound was overvalued, Britain's economy was weak, inflation was high, and interest rates were unsustainable. This was both a challenge and an opportunity. Most investors feared betting against the central bank. Soros, however, saw that the fundamentals and psychology were against the pound. He borrowed billions of pounds and sold them short. When the British government finally gave up defending its currency, the pound collapsed, and Soros's fund made over $1 billion in one day. Lesson: even the strongest institutions can't fight reality forever. If the fundamentals and psychology align, the opportunity is massive. Principle 3. Risk-taking with conviction. Soros wasn't reckless, but when his conviction was high, he went big. He often said, when I see a bubble forming, I rush to buy, adding fuel to the fire. He wasn't afraid to go against the crowd. His challenge was always balancing bold moves with strict risk management. He cut losing trades quickly, but scaled aggressively into winners. Lesson: size your bets according to conviction. Stay small when unsure, but don't be afraid to go big when everything lines up. Principle 4. Adaptability. Markets constantly change. What worked yesterday may fail tomorrow. Soros thrived because he was adaptable. He reversed positions quickly if evidence changed. Pride never stopped him. Unlike traders who cling to being right, Soros focused on surviving long enough to capitalize on the next opportunity. Lesson: flexibility beats stubbornness. Stay humble and adapt. Challenges Soros faced. Even Soros, with all his brilliance, faced major challenges. He often had to withstand criticism and political backlash. Not every bet worked. He lost heavily betting on tech stocks during the early 2000s bubble. His philosophy of uncertainty meant constant self-doubt, which he admitted took a mental toll. But these challenges reinforced his key belief: protect the downside, and the upside will take care of itself. Key takeaways for traders and investors. George Soros' legacy isn't just about $1 billion trade. It's about a mindset. Accept uncertainty. Being wrong is part of the game. Watch psychology and reflexivity. Markets create their own reality. Manage risk relentlessly. Small losses, big wins. Bet big when conviction is strong. Stay adaptable. Never marry your position. Outro. Call to action. George Soros proved that the greatest opportunities often come from the greatest uncertainties. His story isn't about luck. It's about philosophy, adaptability, and courage. If you enjoyed learning these strategies, subscribe for more lessons from the world's greatest traders and investors, because the best way to prepare for the future is to learn from those who mastered the past. This script cuts out childhood life history and focuses directly on strategy, challenges, opportunities, and lessons. Perfect for your long format educational storytelling style.